If you have a business that only made profit for 1 year, that business is worth nothing. It's only worth the amount of cash you got out of that business, and you cannot sell it. As Atena mentioned, if you have a business that's doing $1 million of profit, you could potentially sell that for 15 or $20 million. You have to have the right business, you got to have the right scale, and you got to have it set up the right way for the investors to actually want that. But that is the most important thing that goes into these businesses.
So Kishan Patel, he's a former Wall Street investment banker who led over 20 billion in mergers, acquisition, and capital raises. His client roster include Fortune 500 companies, CEOs, billionaires, and some of the world's largest investors from the private equity and hedge funds. Renewed for his sharp strategy thinking and his ability to engineer high-stake deals, he became one of the youngest managing directors on Wall Street before the age of 30. Today, Kishan empowers high-performing business owners to elevate their companies and unlock hidden value by applying the very same Wall Street strategy once reserved exclusively for billion-dollar enterprises. His clients are established businesses that have built something tangible, but they know the real opportunity lies in transforming their company into a strategically designed, irresistibly valuable assets to strategic buyers and the investors for future partners. Whether or not a business is exit is part of the immediate plan. Kishan reveals how to engineer and multiply a company's value, giving owners the leverage, flexibility, and wealth building power that most entrepreneurs never achieve. Everyone, please welcome Kishan Patel. Hi, Kishan.
Hey, Atena, thank you for the introduction. Great to meet everyone. Good morning, good afternoon, good evening. Where I think you guys are all over the world, so it's great to connect with everybody.
Yeah, no worries. Just before the Kishan started presentation, I know everyone in this group, you guys are ambitious. The reason you are here, you know AI is the trend. You want to take advantage of the trend. A lot of you missed the dot-com bubble. You missed on the Bitcoin when it was like $1 or it was cents. And now we can see the opportunity and again. And that's why we have Kishan here, because we want to build a company that potentially to have a high multiple for exceed our valuation, right? Because some of you may thinking, oh, my goal is to make $1 million or $1 million profit. But one thing that you don't realize that $1 million business could potentially someone buy it from you for $20 million. This is something you don't know. And that's what something you need to plan for because like myself, that's my plan. My plan to have $1 billion valuation company. Like I clearly tell my goal to everyone. I have no fear of telling that. We're planning for that, but doesn't mean I have to make $1 billion. No. If I can make $100 million in revenue, my company already value $1 billion, right? So this is the direction we are going. That's why I want everyone to have an open-minded about the direction that you could build a business for that high multiple exit in a couple of years, or you never know. So that's why we're here. And then when I met with the Kishan had started giving me some strategy because he was telling me, are you looking for investors? I'm like, no, I'm not looking for investors. I was like, you're not looking for, but you need to get prepared because in a 6 months time, you may be needing an investor for this, to execute this plan. I was like, okay, well, that's my problem for 6 months time then. Then he was like, no, if you want to get investment, you need to like start preparing now. You need to get connected with them now. You need to be in front of their eyes, right? This sort of thing that I didn't know. So that's very, very valuable to understand the fundamental in the case that you guys want to have that high exit valuation, especially with AI. And one other thing that it's predicted going to happen, a lot of these small AI companies that form, what's going to happen at these big AI companies like OpenAI, like Meta, and they might buy you out. So imagine if you're going to be a small AI business making like $1 million, $10 million, right? With some momentum. Then the big AI company, OpenAI, might start saying, you know what, I'm going to buy all of these small AI businesses, right? Because they can get the client, because they can get bigger. And then all of a sudden, they're going to make an offer of $10 million, $20 million, $100 million. You never know. So this is a trend that we're going. So you guys need to be prepared for that. And I need to take our opportunity that we are right now. So, don't have regression later on when you hear this success story coming up in the next few years. All right, Kishan, back to you. I think that's enough doing the introduction.
Amazing. Thank you, Atena. That's absolutely right. This group, I've heard a little bit about it from Atena. It's a very powerful group. You guys are at the forefront of a very rapidly growing industry, which is very good because a lot of wealth gets created in that kind of space, right? As Atena mentioned, the internet bubble, you had the Bitcoin bubble, the crypto bubble, the AI. I don't think it's a bubble yet. I don't think people even recognize how big AI is going to get and the amount of transactions and the wealth that's going to flow through AI. And it's going to be both in terms of you making money in your business. And also, as Atina mentioned, there are going to be massive companies that are going to literally scoop up all these other small companies and literally pay them premiums because they want to get their customers, they want to get their databases, they want to get the businesses that these companies are building, right? And so as Atina and I were thinking, we're like, wait, how do we help your group, this team here have the right framework for thinking about, well, what do I do with my company and how do I ultimately set it up to be successful and be acquired? And one of the points I'm going to touch on in my presentation, which we'll put on the screen here in a second, is making money is not the only goal of your business. The goal of your business is to make you wealth and create liquidity through that business. And I'm going to show you exactly what I mean. And as Atina mentioned, you may be starting off making $10,000 a month, or you may be making $100 million a year, right? But if you only make that for 1 year and it's not the right type of revenue or the right type of cash flow, you're not going to be able to convert that into a high value exit for your business. It doesn't mean you have to sell. It could be a very good business where you can make the money and make the profitability, but the option and the ability to be able to do that is what's going to keep that longevity going. So I'm glad to meet everybody here. Let's jump right into it. We're going to have a presentation on the screen. I will go through this. It will be open Q&A in terms of the approach. So if anybody has any questions, just jump right in and we'll answer it. Otherwise, we'll also have Q&A at the end. So the context for this presentation is, how do you build and exit your business for billions of dollars? Now, I don't think everybody needs to exit their business for billions of dollars. If somebody exits their business for $100 million, $200 million, $50 million, that is still life-changing sums of money. But the idea is the people that are going to pay you $50 million or $100 million or $200 million for business are thinking like the people that build and buy $100 million businesses and billion-dollar businesses. So let me just paint the high-level picture of what this, the whole strategy here is in the first place. Imagine you're building a business that nobody wants to buy, and you don't even know that nobody wants to buy it. And instead, what if you could build your business at the same time while transforming it into a powerhouse that buyers are fighting for? This is a common mistake that entrepreneurs and business owners are doing all the time. I'll show you exactly what I mean with this context, but you don't want to go into something non-strategically, just focus on the revenue and the cash flow and not focus on the value of your business in the long term. It's going to be detrimental and you're going to leave lots of money on the table. So let me jump into my background. I'll go really quickly. My goal here is not to bore you with my background, but I think it's important that you understand where I come from and what my history is. Otherwise, all the advice that I'm giving you doesn't really have a lot of value. As Atina mentioned, I was on Wall Street. I lived in New York City. I was an investment banker for 10 years. I was the youngest senior banker on Wall Street before 30. Unheard of, doesn't happen. But I was involved in over $20 billion of transactions that I completed personally while I was on Wall Street. I've done M&A deals, buying and selling companies, raising debt and equity capital, doing restructurings. I've seen how businesses go bankrupt and go down. So understanding what makes a business good versus bad. And my clients were the largest companies in the world, public companies, CEOs, CFOs, C-suite executives, billionaires, the private equity firms and the hedge funds. And importantly for this group, my clients were private equity firms. My clients were investors. They were the people that are buying companies. So I would go market a business, I would go sell it to them, and they would give me the feedback right away. Why do we like this? Why do we not like this? What makes sense for this business? I've got a bunch of detail here. It's probably hard to read, but I've done deals all over the space. I've done things in crypto. I've done things in energy. I've done things in retail. I've sold industrial companies. I've sold power plants. I've sold stores. Most of my clients were $400 or $500 million in size. Many clients were multi-billion dollars in size. It just ranges all over the place. But the perspective I want to share with you is I've done over $20 billion of deals. I've seen over $800 billion of deals at my firm. And I've seen even more companies and business models and plans that I've analyzed on top of that we never got involved with. So any business, and AI is a very new business, but I understand the business model from a software and tech perspective and understand how the market would appreciate it. I'm going to be able to share those insights with you as we go along in this call. And if anybody has any specific questions as we're going along, again, please stop me. So the paradox that business owners fall into is you're doing things correctly and you're doing things incorrectly. So there are a couple things you're doing correctly. One, I congratulate all of you. You've taken the challenge that 95% of people will never do. Nobody goes out and builds a business. Nobody takes the risks. You are entrepreneurs who are looking to build massive amounts of value and wealth. So that is very commendable. Now, what I want to make sure happens is you do that strategically and you don't build a business that ultimately does not give you the value for your hard work that you want. So I know you're surrounding yourself with the best. You're working with Atina. You're working with other people. You want to build massive wealth through your enterprises. And I think you recognize that business ownership and growth is one of the fastest ways to generate wealth that you control. You can invest in stocks, you can invest in crypto, but those things you don't control. In business, the most important characteristic of owning building a business is you can control it. There are things you can influence, especially in a company like an AI-based business where you have software flexibility, you have technology flexibility. You can rapidly change and scale your business. You can build significant amounts of wealth and value very, very quickly. Now, what do most people do incorrectly? One is they focus solely on the product and service. They are so focused on the development early on, and they are so focused on fulfillment that they are juggling multiple fire drills and they are always involved in the operations. That's important in the beginning. And anybody that's in the early stages of the business knows that you have to get that right. Ultimately, your product and your clients are important, but most people never spend time to focus on the finish line and go work backwards and do the strategic steps to make sure you get an exit. Because I'm going to talk about it right now. The purpose of your business is not to make you money every year. It is important that you do that. It is good for your lifestyle. It is good for your earnings, but that is not the true value of the business. One-time cash flow and profitability is the least valuable asset and component of a business. If you have a business that only made profit for 1 year, that business is worth nothing. It is only worth the amount of cash you got out of that business, and you cannot sell it. As Atena mentioned, if you have a business that's doing $1 million of profit, you could potentially sell that for $15 or $20 million. The idea is that you create a recurring revenue stream that is monetizable and you could sell for an enterprise value later down the road. You're going to make way more money selling a business that is valuable in one event, one liquidity event, than you are going to make money that, running a business for one year. So again, the purpose of your business is not to be a cash flow vehicle. The purpose of your business is to become a vehicle for a liquidity event that's going to give you significant wealth very quickly. You could sell the business, you could raise money, you could bring in investors. All those things are possible, but that is how you make absolutely life-changing sums of value. Are there any questions at the moment before I continue?
And Deb, you have a question? You go ahead.
Yeah, thank you. Appreciate this presentation so far. So awesome. The question is, you said the purpose is not to make money. Cash flow now is to have, recurring revenue that will be of some value in the future. But I mean, I guess it's conflicts with other things that we learn as far as from my accounting background, I should say, that, cash flow is very important. And I guess profit is not as important, but cash flow is also important. So what are your thoughts on that?
So there's different phases. Cash flow, I agree. Cash flow is king. I'm not saying your business should not make money. Your business should absolutely make money. But the idea is that set up your business and think strategically so that the type of cash flow you're getting is going to support a high valuation and be able to sell your business. So you have immediate cash flow. Your business needs to make money this year, this month to pay the bills. All those things are important. You have to make that. But then you also have the idea, am I building a business that could rapidly scale 10 times, 15 times? And I may not have that cash flow today, but the investors are going to pay for that because they're going to see the potential in that business. And so therefore, if you're building out that market, you're going to have a much higher chance of selling the business, and then you're going to get the cash flow from the sale. So it's both. You're in the beginning, you're reconciling, how do I keep my business afloat? How do I make the bills? How do I keep it running? All that stuff, and you've got to do that. And then once you've got a little bit of stability, then it's like, okay, let's not just get super focused on running the business. Let's also make sure I'm analyzing my business and looking at it in the way that an investor is going to look at it. Just because I may like the cash flow for 1 year does not mean the investor is going to like that same cash flow and pay you a high valuation for it. So it's a blend of both. Cash flow is 100% important. I'm not saying don't make money in your business. You have to make it. Take distributions, take the cash flow, build the product, build the recurring revenue. But then once you have a little bit of comfort, make sure you're looking at your business holistically. You're not just bogged down in the wheels. You're going high level and then saying, hey, what is an investor going to pay for this? And how are they going to look at my cash flow? Because they're going to look at it very different than you're going to look at it. I'll show you exactly how they look at it. But that's how I would think about the two.
Great. Thank you.
Thank you.
Okay, great. So now what is a liquidity event? A liquidity event is a transaction that happens in your business where you get a significant amount of capital from your business. Either you sell it, you raise financing, any type of transaction. It's not the ordinary customer buys your product and you get revenue and you cash flow from that. So what you want to do is every single action that you're doing, you want to think about it in doing two things in how to achieve a liquidity event and doing these things that are going to further the ability to get a liquidity event. One, increase the enterprise value of your company. So just make your company more valuable, more revenue, more sales, more profit, more customers, anything that makes your business a better business. And then two, how do you increase the marketability and the desirability of your company to investors? So this is a very different angle. Most people don't have access to this because most people don't deal with investors or buyers, and certainly not at this level. A lot of this advice has been reserved exclusively for Wall Street. I dealt with billion-dollar companies. People, that had 10, 15, 20, $50 million companies really never had access to this type of insight. But these are the two most important things you should think about as you're building your business. How do you increase both of those things? Now, I'm going to give you an example of, two companies. Hypothetically, if you had two companies, one, it's doing $10 million of revenue and $3 million of EBITDA. EBITDA is basically profit. This first company, let's say it's valued at $7.5 million just based on its operations. The founder built it, they're running it, they haven't done anything specific or special to do it. They just, they hustled, they grinded, they built this business, and it's generating cash flow. The second company is going to apply very creative structuring, strategies and techniques using this Prism model, which I'll talk about in a little bit. And their company, when they go to sell it, is valued at 21 million, or even potentially more. That's literally a $13.5 million increase of value just because they are structuring their business and building it the right way, such that investors want to pay them a high premium. And it's not very difficult. It's actually not hard to do. You just have to be able to think how an investor thinks. I'll show you exactly what some of these characteristics are, but it can make a massive amount of difference to your business. Now, the one point that Atena made earlier was if you have a $1 million business, it could potentially sell for $10 or $15 million. This business, for example, is doing $3 million of profit, and it could sell for up to $21 million. The value in a business is being able to capitalize it and have a buyer pay significant amounts of money for it. Buyers will pay, a regular business, somebody might pay 6 to 8 times profit. AI technology businesses could be 15, 20 times profit because these businesses have rapid ability to grow and are in high demand with investors right now. And so every dollar that you're generating in earnings, think about it as generating $15 to $20 of earnings value potentially for your business. Now, you have to have the right business, you got to have the right scale, and you got to have it set up the right way for the investors to actually want that. But that is the most important thing that goes into these businesses. Software, tech, SaaS, all of these things are valued at very high multiples. So these two companies, what are the differences between these two companies? Company A is successful, they generate cash flow, but it may be low value or even unsellable. And company B is successful and strategic, and it is a high value asset. I highlighted a couple of points on underline here. We won't go through each of these in detail, but let's say company A, 80% of its revenue comes from 3 clients. The founder handles all the sales and the key relationships, and they're just a generic kind of business. They're a full service agency. They do a little bit of everything for everybody. There's not any real differentiated pattern for that business. So that may sell for $7.5 million, 2.5 times earnings, maybe 3 times earnings, not a significant amount of value. The second business, on the other hand, has the exact same amount of revenue, and the same amount of profitability, but it has so many customers. No one customer makes up more than 10% of revenue. So it's super diversified. It's very stable. A lot of the revenue is recurring. So they've got contracts. They've gone and restructured the way they sell their business, their products to their customers, and they've positioned themselves as a category leader. They've niched into one specific category, and they've become the expert and the well-known person in that category. Now, this business is way more strategic and way more valuable to investors, and they're going to be willing to pay more for that business. So you may get 7 times the multiple, and that's even low. Again, this is like a regular business. This is not necessarily an AI business, but a 6 to 8 times multiple. Now you're getting a $21 million exit plus maybe more over time. So if you just change the way your business operates, you can literally attract way more capital and investors for your valuation when you go and sell it. So I don't know about you, but if I'm building a business for $3 million and I spend a lot of time and energy going into it, I want to maximize every single penny I could possibly get out of this business. I want it to be worth the most, and I want the most proceeds out of it. And so the way to do that is you have to think like an institutional investor. So my goal for you in this presentation is literally very simply help you understand how investors and buyers evaluate businesses. They value them. I've done over $20 billion of deals. I've seen every transaction that you could possibly think about when it comes to the large investors, and every investor thinks the same way. Even if they're not on Wall Street, if they're not billion-dollar investors, they will fundamentally still think this way. How do you increase the value of your company without necessarily increasing revenue? There are levers you could pull that are internal to your business organization. There are levels you could pull with respect to revenue. You can go buy companies. There's lots of strategies that you can implement. but the goal is ultimately to increase the value. And then I want to show you exactly, you'll have a map for thinking about, hey, what is holding me back in my valuation? What stage am I in? How do I fix it? And why is it critical to fix it now? Because if you get too far in and you built a company that's too large and it doesn't match the profile, it is very hard to reverse a large ship. If you have a small ship, you can move the direction of that ship pretty quickly. But if you've built a large ship and it's just got a bunch of holes in it, it's going to eventually sink, which is not good because you've wasted your time and your money. We want to build it the right way from the beginning. Now, why is this important?
Yeah, I have a question, if you don't mind.
Sure.
So speaking of the recurring revenue, and I love that discussion because what we encourage all of our members to do is obviously like a Skool community, because a Skool community is all about recurring revenue. So you can set up a pricing to be either MRR, monthly recurring revenue, or annual recurring revenue. So from your experience, monthly recurring revenue, let's say there are two businesses, business number 1 and 2, they're making the exact same money, but one is making $10 million out of the MRR, monthly recurring revenue. The business number 2 make $10 million out of annual recurring revenue, right? So which one would be like value more? Because that's something that everyone here that have a Skool community, so do we create annual recurring revenue or do we create a monthly?
So if both businesses are exactly the same, right? The same service, same product, same price, it's just broken out into monthly versus annually. I would say, assuming that there's no difference in churn rate, right? Assuming that all the monthly people will renew, all the annual people will renew in the same context, the annual is a much more valuable business. Now, the reason it is more valuable is because you are getting all the cash flows up front, and all that value is today. I would rather have $100 today than $100 in 1 year. Does that make sense? Because your 100, you're splitting up 12 different ways and you're collecting it later, and there's risk around that. And you can use the $100 today. So that is, now, again, if creating the annual makes it so that your business is harder to renew and there's more churn because somebody comes up at the end of the year and is like, oh, I don't want to spend $5,000 because that's a big number, but they're okay spending $350 or $450 a month, in that case, I would go monthly. But it really depends on the dynamic of your customer, and it depends on what your business model is set up as. But if you hold everything constant, revenue is the same, churn is the same, sales are the same, all of that is the same, then annual, because you're collecting all the cash up front. And that's more valuable to the business than it is collecting it over time. Because your service costs, are going to be over the year, but you're getting every revenue dollar up front. So it really depends. But every business is not equal every time like that. So it really kind of depends on what scenario you're setting up, and what your customers look like.
That makes sense. And usually with the MRR is more churn actually. It's a higher churn because people every month they're looking at it say, oh, I'll have to pay another this much every month psychologically. Versus the annual they pay and then
I mean, the MRR model is the couple of benefits of the MRR model is you get it up front. Sometimes people will continue to participate in it. You can upsell much easier probably into that MRR if you've got the engagement. There's pros and cons to both. If you've got institutional corporate clients, the annual model is probably better because that's how they tend to operate, and you can lock people into contracts. The consumer model, monthly is probably a little bit better. It really depends on your customer and your client.
Okay, thank you. Leo?
Yeah.
Oh, sorry. There you go. Oh,
I could do this, thank you. Kishan, it has been amazing so far. The question is that I've seen somewhere, which is that basically Facebook and other companies have $1 billion evaluation or even millions. And even that, if they are actually negative revenue, how does that happen? And there's something I've heard, which was interesting, right? It's not about return on investment, it's about return on interest. That basically gives them the value. Is it somehow true? Or like how does that basically work? So basically companies too new to actually produce revenue, but it's expected to make like billions of dollars.
So it's exactly right. It's because of the expectation. So when I said the cash flow is not important, let's talk about Facebook, let's talk about Instagram, let's talk about Uber. All of these companies in their early stages did not make cash flow. They were cash flow negative. They were not profitable. Amazon to this date is still not profitable. If you take out its web service business, the web servers, its hosting business, the delivery company is not profitable. But Amazon is one of the largest companies in the world. But why are people valuing it so high? Because of the expected future cash flows of that business, the future probability. That is why AI is so powerful today. AI is powerful as a valuation, vehicle for people because the future possibilities of AI companies are massive. So you may not be valuable today. That's not what people people are paying for. But if you can prove that you're going to make cash flow in the future, investors look at that. There are two ways people value businesses. The first is based on current earnings and current performance. So these are for more established businesses. If you have a manufacturing plant, you have a retail store, they look at what your earnings are today, they apply a multiple to it and say, hey, this is what we think your business is worth. The other way is you could look at future cash flows. It's called a discounted cash flow analysis. You look at the next 5 years cash flows, you discount that back and say, hey, what are the probabilities of those cash flows happening and then continuing to happen in the future? And you evaluate that, and then that's one way to look at it. All these large unicorns are basically being said, hey, we don't think you're profitable today, but we think you're going to be so big in the future that the value of that, when we bring it down to today, is worth paying these values. So now you need funding, so you need to be able to raise capital in order to survive, right? Because you could be valuable, but you may not have cash. Which is why a lot of these companies raise money from Wall Street and Silicon Valley and all these other places in order to run their businesses. But that's exactly the way. I'm not saying you should run on fumes and not focus on profitability, because these are different stages of the businesses. If you're early on, you need to focus on customers and then profitability. But once you get established, you need to make sure you're thinking about, how do I make sure this company is going to scale and be sellable? Does that make sense, Leo?
Yeah, it's awesome. And like the follow-up question would actually be how do early on investors, and I think it's what I just realized through you saying is there's one business model which is actually trying to get profitable, and then investors come in or exits based on the current evaluation, if I understand it right, and basically on the current earnings. Or the other option is basically it's just predicted revenue, and so to basically survive, you have to get investor funding from the get-go. So like the two small follow-up questions on these. Is it that basically to get those initial investors, it's basically your ability to pitch and the idea behind the business that really comes into place? And the second thing is, when you then sell the business, how do investors play into the sell? Early investors, how do they play into the exit?
Yeah, so very nuanced question. I'm gonna try to answer it like in a direct way. But if you're not making profitability as an AI tech business, like, I don't think you need investors early on. I don't, unless you're just really you don't have any capital at all and you're going to friends and family. But I wouldn't really consider friends and family as like real institutional investor capital. You should be able to build AI businesses, I think, for relatively low capital. The tech is all available, all the resources are available. If you're building like a manufacturing plant, yeah, you need a lot of money, but like you're not going to raise money for that, at an early stage if you've never done it before. So, and the other problem with that is, if you try to raise capital from external parties, they're going to take a large percentage of your company. And so they may take 30%, 40%, 50% of your company. And then when you go and sell it for 10, 15, 20, $50 million, like, you've given up so much of your company value just because you needed their liquidity. I would try to focus on how to build a product and a service that doesn't require a significant amount of capital to both build and grow. And there are ways to do that because technology is just so powerful. But the way these investors are handled later is they become owners of your business, right? So they may own 30% of your business. So if you sell it later, let's say you have a $100 million company and you sell it and you give away 30%, well, you got to give them $30 million as a repayment for their capital. And they may have only invested $2 or $3 million when you initially started, because that's how they said, I'll give you $2 or $3 million for 30%. If you've ever seen Shark Tank, that is exactly how Shark Tank works, right? They give you, I'll give you $250,000 for 40% of your company, and that company goes and becomes a $50 million business, and Kevin O'Leary and those guys make massive amounts of money. That's how venture investing works. They take the risk early on because that business may fail, but they're saying, hey, there's potential here and I trust the owner. Now those businesses, a lot of them are like manufacturing and supply chain, and they've got real products and stuff like that. They may need the capital. I don't think in the AI space you need a significant amount of capital. You may need some coding, you may need some support, but all of that I would try to round up through friends and family if you're early stages. Now, if you're like an established AI company and you're trying to scale, you're already doing $5-10 million of revenue, and you're trying to grow a sales force and you're trying to grow marketing, then yeah, you may need a bank, you may need an investor, because you realize, hey, I might take my $5-10 million company and make it a $50-100 million company, and it's worth the cost of taking on the investor because I'm going to get a bigger pie. I'm going to get a smaller piece of the pie, but there's going to be a bigger pie. Does that make sense?
Fantastic. Jonathan?
Perfect. Absolutely perfect.
Great. Thank you, Atena. Kishan, really awesome intel here and information. Really appreciate it. This is so valuable. So I have a macro and a micro question. So
Yeah.
I'm in an industry, Kishan, okay, that would not have like the multiples of 20s, okay, like an AI agency. Very specifically, I run a college admission consulting company. With that being said, I spoke to a mentor and also is an industry leader in this field, and she said that most IECs, independent education consultants, are absolutely not early adapters. They are resisting, which got me to think, I'm one of those early adapters. I would like to position our company as being very AI friendly because I know teenagers love those, who embrace technology and so forth. So I guess my first question is, how can we position ourselves, what I'm saying, whereby we can take a rather kind of traditional kind of business and but by leveraging AI make it much more appealing to future investors. So that's my first question, and then I have a second follow-up.
Yeah. So my perspective on it, education is a massive industry and very, very valuable because it's recurring in the context that there's always new people, there's always new kids, there's always parents that are trying to buy programs for people. College admissions are getting harder and harder. It's getting more and more expensive.
Yes.
The way I would
Yes.
structure your business is I would make it so that you're doing what? Consulting for like how to get into colleges?
How to get into very selective colleges. That's our IP.
Yeah. So, I mean, I would make programs around it that include, AI generated content. It evaluates the student's performance. You don't need an instructor. It can read the students', test results, all of that kind of stuff. It can predict where they should be improving, like a very integrated construct, like a platform that really just gives them the full access. And the reason you want to do that is because you don't want to have professors, your lecturers that you're hiring and you're paying and you got labor. You want to basically have a robot that can do that. And then you create that, you have a recurring model. You get people started when they're freshmen, sophomores in high school. You have a 2-3 year long kind of, LTV on these customers and parents. You don't make it super expensive. And then you package the whole thing up and then you sell it to like McGraw-Hill or Pearson or Blackboard. I would sell it to one of the, educational software platform companies and just basically make a AI layer, an engine that basically helps, replace teachers is kind of what I would do. The big picture is not consulting. The big picture is how do you make an AI that can replace teachers and literally predict where the student is having trouble. That's kind of where I would go. If I were trying to monetize it, that is the biggest monetization platform I would think about.
When you say replace teachers, are you referring to replacing us, the coaches, the college admission
No,
coaches?
not the coaches. The coaches come in on top if you need
Yeah.
personal and human touch. But you don't
Yes.
need a tutor, you don't need office hours, you don't got to buy a bunch of books. This AI has access to every single book. This AI has all the videos from the classroom lectures. This AI can talk to the student. It knows exactly what the student is struggling with. This person's a visual learner, this person's an audio learner. It generates the content. I don't know how to do all that. I'm not an AI programmer, but I'm saying that is that's the platform. And then you sell that technology to the guys that host all the online classrooms and all the textbooks, and they would buy that, right? Because they can put that into all of their platforms.
Got it. Okay. So obviously, it'd be key to identify a good, solid developer, AI developer.
Yeah, it's like your kid. It's like you're a father and you got to take your kid to tutoring after school every week, 3 times a week. Instead, why don't I just give them this AI app and it'll just literally, read the syllabus, read the books, show me everything I need to do. I don't got to drive to Kumon. Like, just replace Kumon.
Love that.
That's the biggest market.
Thank you. Yes, that's so helpful. My second question is, this was immensely eye-opening when you said in company B, the appeal is that no customer basically has 10% of the revenue. So our current model. Yeah, our current model is we sell premium packages. And so that's our case right now. However, we are going to be pivoting and adding a different offering, specifically more and more private group coaching that are way less expensive and so forth.
Sure.
So I'm assuming that in our offerings, we want to make sure that when we do the math, the private group coaching, the offerings literally will make up, say, 90% of the revenue versus or 10% or more. Is that what I'm hearing from you?
Yeah, it really depends. I mean, it really kind of depends on your business, right? Like most businesses have like 2 or 3 kind of offerings, right? So you'll have like 20% of revenue from here, 40% from here, and then you'll have 40% from something else. And then within those 3 divisions, you'll have probably one customer that's big in, one particular sector. Like it's pretty rare that, a company will have super diversified revenue all the time, right? Like let's think about Starbucks. Starbucks has unlimited customers. It's like there's no one customer that's ever going to be a big factor in Starbucks's revenue. So Starbucks is very, very stable. Now let's talk about like Taiwan Semiconductor. Apple buys chips, Samsung buys chips. Those guys are probably pretty big. There's risk around those guys. If Apple decides to move away from, I don't know if Taiwan makes the semiconductors for them, but whoever makes their semiconductors, if Apple moves away, that's a big hit to their revenue. Now, Apple
Yeah,
is so
yeah.
big and Taiwan Semiconductor is so big, it's probably not as big of an issue. But you talk about some companies that have government contracts and military contracts, they only have one customer. That customer goes away, you are literally your company's gone. You don't have a company, right? So I don't think your problem is as much of an issue because your customers are by definition going to be diversified. The only question is how do you make your customers LTV very big, and so you're not churning $50 clients here and there. You're getting $5,000 packages or $10,000 packages, and they add up.
Final question: who do you perceive as our customers?
I mean, I think in the beginning, your customers have to be the schools, the teachers, the parents, all of those places. And then I think eventually your business's customer, who you want to sell your business to, is those educational platforms. Like I think they're going to want to buy all the data of all these parents, all these students. They're going to want to buy the AI, all the tech. Like I think in the beginning, it's build your business, and then in the end, it's sell your platform.
Awesome. Thank you so much. So helpful. Appreciate you.
Yeah, no problem. Okay, so the opportunity, why this is important and why we're kind of talking about it now. So the biggest thing that's helpful for people to think about, there's literally over $500 billion of private equity money right now that these funds have, and they want to deploy it. The investors want to buy businesses. They want to pay money for these businesses, and they are going to pay premium valuations. And the reason I say that is there's been so much capital that has been raised by Wall Street and these institutional investors. They are competing for deals. There's more money than there is deals. I don't know if this dynamic is going to last forever. It hasn't always been like this. Private equity and investing and acquiring companies massively grew in the 90s, really grew kind of in the early 2000s, really shrunk during the 2008, crash and all those places. But it has grown massively over the last, I would say, 5 years, and there is a huge amount of demand. So if your business is set up in the blueprint that these investors want to buy it in, people are buying companies for like dumb, ridiculous amounts just because there are no companies available. They have to deploy the money. Otherwise, they're upsetting their investors. So there's a very, very unique opportunity. If you want to set your company up in the right way in the next kind of 12 to 36 months, that capital is going to be there. And you want to make sure you're getting in on that. Now, what is the problem and why do most businesses not sell for a premium? Well, the problem is 99% of business owners don't know how to do 3 things. And these are the 3 things that are essential to make your business, valuable. One, they don't know how to structure a valuable company. So we'll talk about all those different risks and, things like that. They don't know how to value it. They don't know how the investors are going to look at it. They don't know how to do things like go and acquire other businesses and bring it onto theirs and then sell a whole portfolio. They don't know how to present or market their company. So I talked about how do you make it so the investors are interested in the business. There's a specific model we're going to talk about, which we'll walk through 5 things that I think that all investors look at when they value your business. But how do you show your business as, hey, this is more than just me, the founder. When is the right time to sell? Should I even sell? They don't understand how to do that. And then ultimately, how do you actually talk to the buyers and investors? How do you get them interested? How do you get them focused on your business? And then how do you get the maximum value? Most people don't do that. Most business owners, I'm assuming like you guys, are focused on running your business, making it profitable, keeping your employees happy, keeping your customers happy, and literally just running it day by day, trying to make money. That's super important. But if you don't focus on it, you're going to leave millions of dollars on the table when you go to sell, if you can sell. So don't leave the fate of your company up to chance. You need to be thinking about it right now while you're building it. Okay. All right. So here's the framework. Here's the right way to think about companies. And this is a very, very high leverage, top of the funnel, very strategic view of how to evaluate businesses. You're looking at the value, you're looking at the scalability, and you're looking at the attractiveness of a business. So I break it down to 5 things. I've looked at deals, like I said, over the last 10 years. I've sold companies, I've bought companies, I've raised hundreds of millions of dollars. I think about it in 5 ways. 1 is predictability. 2 is replaceability. 3 is infrastructure to be able to scale. 4 is strategic positioning, and then 5 is moat and defensibility. What does that mean? On your revenues and your earnings, how consistent are they? How much of them are recurring? What is the quality of your earnings? Can somebody look at your business and say, hey, there's actually a stream of cash flows. There's a real business here. There's profitability. I know how to make this business make money over and over and over again, or I know how to make this business blow up and become massive. If somebody has that, that is a very, very good foundation for a business. Replaceability is, how does this company run without the founder? This is a bottleneck the founders have all the time. They are so integrated in their business. They don't have teams in place. They don't have systems in place. And I understand that it's difficult, in the beginning. It's not always the easiest thing to do in the world, but you have to make your business run without you. Warren Buffett has a famous saying, he doesn't buy any business that can't be run by an idiot. He literally wants every company that he has to be so simple and so easily replaceable. If anything ever goes wrong, it's not dependent on anybody. That is how you make a business, valuable to an investor, because they want to buy it. They're not going to run it. They just want to buy it. They want to install a management team, and they want to make cash from it. The infrastructure for scale. How do you grow this business rapidly? Can you build it? Do you have more customers? Can you go and buy other competitors? So if you have a company that can't grow, your company is not going to get a lot of value. But AI is a very specific industry right now because it has so much infrastructure to grow. You can literally triple, quadruple, 5x, 10x your business in a year. You can make it massive. And in 5 years, who knows how big it's going to be. So that is why people are going to pay very high valuation multiples for AI. Your strategic positioning. Is this a good business? Do people like it? Does it feel good? Is it attractive to the capital markets? Right now in the capital markets, AI and tech are hot. So you take that trend, you attack it, you capitalize on it, and you take advantage of that. And then moat and defensibility is, what is your competitive advantage? How do you prevent competitors from coming in? Is your technology really proprietary, or can somebody just recreate it? If somebody can recreate it, you're going to have a very hard time selling your company, because why would they buy your company if they could just invest, $500,000, $1 million, and rebuild your entire business? If you don't have anything very specific about you, first mover advantage, proprietary code, IP, customer recognition, brand, all these things that are sticky and make the customer say, hey, I want to go to this guy, you're going to have a hard time selling your business. So apply this to your business. Think about it. Does your business fit within this landscape? This is I think the ultimate toolkit for business valuation. I've tried to think about how to condense this. The largest companies in the world have elements of each of these frameworks and the pillars in their valuation. The Prism framework can apply to all of these. I'll show you guys a couple of examples of how we think about it for the large companies. But unicorns are going to get this billion-dollar status because of the characteristics in the Prism framework. There was a question on, earlier, Facebook and Instagram, they don't have profitability. Well, they have massive potential for scale. That is why those companies are so valuable. So I'm giving you guys literally 10 years of institutional investor mindset and diligence processes into a very, very simple framework that you can use to think about businesses. I've got slides on each of them. You guys, you can read this at a later date. I won't go through every single one of them, but predictability is all about, how good are your cash flows? Do you have long-term contracts? Do you have low churn? Do you have quality financials? Are you able to project your business? The negatives are, if you got one-time sales, it's lumpy, you got a lot of turnover, you have no pipeline. All of that is a negative to your valuation. The replaceability, the biggest thing here is key man risk. If one person in your company were to fall apart, whether it's the CEO, the sales manager, the marketing manager, operations manager, if this person were not available tomorrow, would your business fall apart? If the answer to that is yes, or you're even worried about it, an investor is going to see through that right away. You have to make the systems and the processes set up the right way such that anybody else can come in, run this company professionally, and build a good organization. If you have anything that doesn't do that, people are going to see through it right away. The infrastructure is probably one of the biggest things as it relates to AI companies, because the large total addressable market, Instagram had a massive market. They had so many users. They weren't focused on profitability. They were literally focused on just getting as many users as possible. And then they were sold to Facebook for $1 billion. They weren't making money, but Facebook saw this app can blow up. We're going to get so much data. We're going to get so many people on this. We'll monetize it later. We'll be able to make it, better later. And they did do that. The other thing they did was, can you buy other competitors and scale through M&A? Can you make your business bigger just by buying competitors and absorbing them? Well, Facebook does that all the time. They bought Instagram, they bought WhatsApp. They literally combined all these companies together, and they're growing massively. That is why they are so highly valued. If your business model needs a lot of CapEx and investment, that makes it hard to scale. But AI, I don't think, again, needs that at this stage. So those are all really good things. If your business is small, I would not focus on a narrow target market where you can't serve a lot of people, right? For example, a retail store, you can only serve as many people that walk into your store. That is the beauty of AI. You can literally serve everybody online all over the world, make your target market big and make it very profitable. On the strategic side, your business should feel like a good business fundamentally. AI is one of those things right now where it is hot. People are very focused on it. Tech is in favor. Things that are not in favor are coal mines, for example. At one point in time, those are very valuable, but nobody is going to buy a coal mine today. So are there things that are obvious? Hey, this is a good business. I can attach other businesses onto it. If I buy this, I can sell it later because it's going to have fundamental value. You really want to think about what is the investor going to look for when they want to go buy this company. And then moat is also incredibly important. How do you prevent people from switching? You have high switching costs, you lock them into contracts, you have recurring revenue, you make your product so good. Atena's platform has so many tools where, if somebody is using this tool and the content generation, once they have all their programs and their content and their, frameworks built in, it's hard to export that. You can't just rebuild all that. So those are high switching costs that are good. Really great for the business, really great for the customer. And those are things that are very positive. If you have one main customer, that's a problem, right? So how do you protect your business from that? And if you have a competitor that can easily spin up in 2 weeks, that's also a problem. You need to protect against that. So these are the 5 really, really high level frameworks that I think, as you're thinking about building your businesses and you're strategizing, take those into account. So I'll pause here for, again, a couple of questions. I know I may be running close to time, but we've got a few more slides and then we'll open up for kind of general Q&A. But I'll pause here if there's any questions.
No questions.
Okay, so let's talk about a couple of unicorns. So how do you apply the Prism model to unicorns? So let's talk about Uber. Uber has a massive, large global usage and customer base. So their revenues can be predictable. You can see the volumes. There's no one large customer that's sticky. Now, they don't really have any real recurring revenue, and they are not profitable. And there's a lot of regulatory overhang on Uber. So let me give one more framework here. No company is going to have all positives and no negatives. That is not the point. The point is not that you have every single positive and you have no negative. The point is that you have a couple of positives in each category that are so strong that the investors are looking at it and saying, hey, this makes sense. This is the one I want to latch onto. In all the competitors and the companies that are out there, this is the best positioned one. You're, of course, going to have negatives. Every business model has pros and cons. But the idea is that how do I get a couple of really strong pros on my side on each of these categories? And then how do I mitigate and present the negatives such that we're going to overcome them? That's all marketing and presentation, but you have to have the strong positive qualities. So the replaceability, Uber runs without, nobody knows who the CEO of Uber is. It does not matter. That CEO may be charismatic, he may be a leader, but ultimately the business is not dependent on him. The infrastructure is there. They can go globally. They can go into new geographies. The tech scaled very quickly. It's just an app, right? They didn't have to go open a bunch of stores. Same thing with Airbnb and all these other companies that are just creating services. It became the first mover in this market, which is a huge advantage. If you could blow up your company and be the first mover advantage where everybody says, hey, I want to go to this company for AI education software, then everybody is just going to go to that by default, right? So you have such a massive advantage if you're an early mover on that side. Now, there are legal issues with Uber. There are people coming in and commoditizing it, Lyft and Waymo. It's still not very profitable. So at this stage, I don't know who's going to buy Uber. Uber is a very difficult business to sell today. But for the guys that founded Uber, they don't care. They made billions of dollars along the way. And so that's really not your problem. Ultimately, if this company gets sold and funded 5-6 times over, the end result is really not your issue. The question is, how do you make it valuable for you? So that's how I think about Uber. ChatGPT, I think, is a very relevant metric for this community, just given the AI nature of the business. It has a growing subscription model. It has API revenues. You could sell it to institutional clients where they get access to the APIs. They're getting contracts in place with Apple and stuff. But the user growth is far outpacing the monetization. I don't think ChatGPT is profitable. It's hard to say because it's not a public company. You can't really look into it. But their focus right now is not being profitable. Their focus right now is getting as many people into the platform, being the first guy that everybody looks at and says, hey, when I think about AI, I think about ChatGPT. Elon wanted to buy it, but then he went and built his own competitor. So there are competitors that are catching up, Grok and Meta and Google and all these places. But they are very well positioned to create the boom. They got to make sure that they, stay front and center. They got to figure out how to monetize it, but very, very, very good business, from a valuation perspective. Now, there are big cost dynamics, right? They're super reliant on Microsoft. They have one supplier. Eventually, AI is going to get so good that you don't necessarily need ChatGPT's premium versions. Like, you're going to have cheaper alternatives. So they need to keep ahead of the curve until that happens. But because they're a first mover, they're going to have that advantage for a long time because people are going to just use ChatGPT. Apple, again, everybody knows Apple. This is like one of the most strongest recurring revenue businesses from hardware and software. Every year they release a new iPhone in September. Every year they have record sales. People just literally recycle the phones over and over. There's a massive global economy. There's a massive global customer base that they haven't even tapped into. They have a great ecosystem. The App Store is incredible. Everybody loves blue text messages. Whenever you get a green text message, you're just like, oh, what is this? Like, they've built such a moat around their products, with the music, with the movies, the apps, the Apple TV. They're fully integrated on their software supply, their hardware, all of that stuff. It's an incredible business. Now they're facing pressure too, because is the iPhone 17, 18, 19 that much better than the 13, 14, 15? I don't know. Eventually it's going to slow down and they got to figure out how to make more money. But they've got such a strong position that it doesn't really matter. They're going to get that, that high valuation. They are like one of the largest companies in the world, on that side. So again, that's kind of a way to think about it. I'll pause there for just a second to see if folks have any questions on, the material so far.
Leo?
Oh,
When do
sorry.
you know? Sorry. Well, when do you know when is the right time to sell? Because it seems like even evaluation, let's say evaluation can grow, but also like Tesla, like they took like a big hit in terms of evaluation. So when do you know is the right time to sell evaluation?
Yeah, so it's going to be very dependent on your company and kind of what your personal goals and what your dynamics are. I would say if you have a view towards an inflection point, and what I mean by that is your business does $500,000, your business does $1 million, it does $3 million, and the next year it's going to do 10. Don't sell before the 10. Like, go realize the value. You want to sell your business once it's starting to stabilize and you're not seeing as much of a massive inflection point. You still have to leave something on the table for the investor, because if you just say, hey, I'm going to do 10 forever for the rest of the year or for the rest of this business, then they're not going to see the upside potential. But you kind of want to time it right where you're right before the inflection point or in the middle of it, so that you get the value for the growth, but you're not leaving money on the table at the same time. And it really depends on your goal. If you're 25 years old, 30 years old, 35, like, you probably don't need a liquidity event or a retirement event or something like that. If you're 55, 60, 65, or you're an industry where, the industry is trending downwards, then you should probably sell at a time with the market. It really depends on what your company's like. But my advice is you don't sell early on. My advice is you build it, you get it structured this right way, such that people are like, wow, I really want that company. It's such a good business, and it's performing well. It's got a history of performance, and it's got so much upside. That's the point that you sell, because you're going to get the most amount of value while taking the risk off the table, because you don't know what the future earnings are going to necessarily be on that side.
Very good. Deb?
Yeah, so you gave Jonathan really good advice on how to structure his company for sale. I'm in a real estate niche and I do real estate coaching. How would I structure that?
What does that mean? What does real estate coaching mean?
Helping agents get 2 listings per month
Using AI.
using
Helping.
So real estate agents are really bad at understanding AI. They're not embracing it. So I help them create workflow, so that, they can follow up with clients, which put it on automation. They wake up in the morning, they spin around, they don't know what to do. But if it's automated, it helps them with that follow up, which is where the money is for real estate.
I see. I guess there's a couple ways to think about it. One is, and you're working directly with the real estate agents, like individual agents. Those are your clients?
With the agent and with some smaller independent brokerages. Yeah,
I would have said the way to go about it is you build a platform and then you get into the brokerage houses. right? And don't target the agents, because you're going to pick up one agent here, you're going to pick up one agent there. I would go to say, hey, you brokerage house in, you know, Los Angeles, you're a boutique firm, you have 10 agents. Let me install this system for you and show you how it converts better. And then, you know, pick that up. So you got 10 agents now, put them on a recurring model, and then just go pick up a bunch of boutique agencies, you know, all over the country. And then eventually try to work your way into the CBREs, you know, the JLLs, the markets and millichaps. Those are massive organizations. I mean, if you can make a difference for markets and millchap where they close 1% more of deals on the commercial property side, and I would go to commercial, I wouldn't go to residential, because, you know, the residential is, you know, you're selling a $500,000 home or, you know, $1 million home. The commercial properties are 50, 100, you know, $25 million properties, and there's so much more money to be made there. I would figure out if you can create a CRM or a platform that goes into that. And then what is the exit on that? I mean, the exit is kind of like to a Salesforce or, you know, a CRM company or something like that. But it's got to really be of size. I mean, like Salesforce is not building a very specific, you know, real estate platform. But that's how I would try to scale that. I would try to see if you can go into these companies, because CRMs are sold all the time. It's a very easy sell. It's hard to get in. It's hard to get in initially because nobody wants to do the work of building a CRM and integrating it and all that kind of stuff. But if you could actually make it work and actually user friendly for people, and you could show the results, and it converts into sales, I think the agencies would pick that kind of stuff up.
Got it. Thank you so much. So what are you doing now? You
but-
talked about what you did before in the past. What are you doing now?
Yeah. So my background, I was on Wall Street. I was working for corporates. I was working for billionaires. I was working for public companies, but ultimately I was working for, you know, just companies, right? I mean, I knew the people that were there. What I do now is I work directly with, and we'll talk about it here in a second. I work directly with business owners, and I coach them and teach them these strategies. I'm taking all my experience, all my, you know, 10 years of, you know, 80 to 100-hour work weeks, and kind of condensing it into a very easy to, you know, follow format for people. So I'm helping entrepreneurs that want to, you know, set up their businesses for, you know, increasing their valuation and scaling, you know. And part of it, and there's so many more strategies we could talk about. Some of it is like, hey, I own a company and I want to go buy my competitors. How do we go do that? How do we go structure it? That's a way to grow value. How do we just build the foundations the right way? So I'm coaching businesses directly. My business, by the way, just to give you guys an example, is a very bad business for the Prism model. There's no ability to sell my company. There's no ability to sell me. You can't replace my knowledge. Like, it's a shitty business to actually be able to sell. But it's a good, you know, it'll be good for a lifestyle. It'll be good for cash. And what I would do if you're somebody in this position who is watching this, you guys have maybe a coaching business or something like that, where you are the fundamental value, take all that cash and put it into businesses, put it into real estate, put it into investments, put it into something that has enterprise value, because enterprise value is what you can keep. Like cash flow, you can't keep. Cash flow, you use it, you spend it, it goes away. Enterprise value is what you actually have on your balance sheet, and it's the asset that you keep, and you can monetize it later. You don't have to. You can always get money out of it. But that's what I do. I just, you know, when I was doing that, I was advising companies. Now I'm advising, you know, direct businesses on the, you know, smaller side.
I appreciate it. It's a really good presentation, by the way. Thank you.
Yeah, no, happy to do it. Like I said, how do we take businesses to the next level? For example, anybody that's on this call, there are way more strategies and nuances that go into Prism. I try to summarize it, but there's literally dozens and dozens of things that are important that go into it, and you really got to deep dive into it. How do you build and position and strategize your business? You need to be thinking about that now. So a good question on enterprise value. Enterprise value is the value of your company. It is what somebody's willing to pay for your business. It means that you have an asset that is, you know, has some level of value. So if a company is worth $100 million, that is what the investor is willing to pay. That is the enterprise value of that company. You want to make sure you're building that enterprise value higher and higher and higher, so that when you ultimately want to sell it, somebody will pay you that. And then if you have debt, you got to pay that debt off. But the idea is that enterprise value is only real if a company has stability and it has the characteristics of these this Prism model. If a company just made $1 million 1 year, it doesn't have enterprise value. Its enterprise value was $1 million, and you got that 1 million, and you won't get anything else out of it. But if you have a valuable company, you're going to get that 1 million plus $5 or $10 million, because it has enterprise value. It has continuity. And then there's a totally separate process for how you engage buyers and investors, which I didn't talk about on this, but I take people through that entire process as well. How do you engage with the, you know, private equity world? How do you engage with, you know, capital raising? How do you talk to debt financing? Why is it good for your company? Why is it bad for your company? So we show you, you know, exactly how to do all that. How do you make your business super valuable for the buyers, and then add value to it, so you can sell it ultimately down the road. So the one thing I would ask everybody that, hopefully this presentation was very helpful to you guys, but I would assess your company by these questions. How does my business stack up against the Prism model? Who would buy my company today? How much would they buy it for? How do they pick that number? And what do they like about my business? How many investors have I spoken to that would actually be buyers of my business? Do you even know who the buyers in your business are? Who are the sponsors that are purchasing companies like yours? Which of your competitors have been acquired recently? And which of your competitors have received funding or investment recently? These are the very, very pertinent strategic questions that you should always have on the top of your mind. Otherwise, all you're doing is running a company and you're a manager. You're not an owner of your business. The owner of your business is focused on increasing value, and these are the most important questions you could ask. And if those questions literally were like, oh my God, I don't know the answer to this, or made you kind of nervous and like, hey, what's going on with my business? Like that is the exact time that you should be planning and strategizing now, because your business is successful. You want to make sure it's staying successful, and you want to make sure you don't leave behind lots of money on the table when you go to sell, because it can catch up on you. You're not going to notice it. You're running your business, then eventually you get to a point where like, hey, I want to sell, but there's a bunch of prep work you got to do, and you don't have to sell. The point is not that you have to sell. The point is that you know what the value of your business is. So we do all that. I talked about it a little bit here. I walk you through the full A to Z framework. I have a program that's exclusive for high-level business owners. You get the full system, the step-by-step on how you build a business that buyers want. You don't have to exit. We have private group calls. You get straight guidance from me. I've seen, like I said, $20 billion of deals. You get all the frameworks for how investors think about it. It's really, how do we take your business from now all the way to what we think and what we understand to be a very valuable business to investors in a year, over 52 weeks. That way you can, actually have a business that you fully understand, and you're going to be so much more capable when you talk to investors or you're looking to sell your business. So that's my background. I answered that a little bit earlier in terms of what I do. Obviously, we want to work with the best, companies. I've heard nothing but amazing things from Atena about this group. And I love the questions. They were super engaged and very, very thoughtful. So I really appreciate that from the group here.
Thank you so much. So Leo, you got lots of questions as always. Here you go.
Yeah, beautiful. Can we still ask questions to Kishan, or is it to you only?
That's okay.
Okay, cool. Basically, the question, which is a very simple question, which is, there is, for example, Skool, right? The platform we all build around, or even AIpreneurs. And there's a software called fiducia.gg, right? It's a software, and it literally operates only in the Skool platform. So it's basically an AI tool which allows you to manage your community, which CRM has a bunch of features. And I spoke with the owner, and his only goal is to exit to Skool, right? And how do you think about building a company which is basically solely dependent on one potential buyer, because there's no one else besides Skool who could buy it? And if Skool says it's shit, well, it's not worth it. Like, how do you see that?
It's not actually cool to make a point about that. Fiducia, for example, like any of you guys that become big, you're gonna say, I'm gonna buy all of these AI softwares that specifically operate to Skool, so I can get bigger, and then I become the top industry leader about I do everything for the Skool, all the automation. So I don't think it's just like a Skool. They potentially have some buyers from other creators. So that's just my input. Kishan, what do you think about that?
Yeah, my sense is I think if you're building a company that's only for one buyer, they have a significant amount of leverage. It's a very dangerous position to be in. Now, the question is, how much leverage do you have against them, right? How important is your product or your plugin or your AI to them? If it's very important, then you have a very interesting negotiation, because both parties have a lot to lose. Because if you just shut them down, does their business stop working? So the question is, who has more leverage and who gets hurt by walking away? My sense is, Skool probably has more leverage. So my advice in that context would be, okay, build the platform, build the product, but don't spend 3 years building it. Like, go very fast, identify what it is early, get the dialogue with them, like start building the relationships, like have other things that you're probably doing in the background, or find ways to make it valuable to other platforms. Because if the code is only unique to Skool because it's coded for Skool, but the idea is good, you could probably port that to other places and make it more valuable. But yeah, I mean, that happens all the time. I mean, it's a very difficult position to be in because, somebody has leverage, and it's not always going to be perfect. I mean, ideally, you build your business such that, you have 2, 3 buyers, because that way you can run an auction and you can get the best price. But it doesn't always happen that way. Sometimes you only end up with one guy, and then it's like, okay, how do you, if they want the business, then it's like, okay, how do I negotiate price? How do I negotiate? Hey, if this business does really well, I want some of the upside, like stuff like that. Then you get into like real deal dynamics, negotiations. But your negotiating position is not ideal for sure.
Beautiful.
And
Thank you for the explanation.
I actually know 2 businesses that specifically was for a school, and then some of them shut them down. One was a school map. There was a plugin, someone had a school map, and we were using that ourselves, that all the members can, pin in the map and they could get connected. Then what a school did, they said that we have the built-in a school map, and what happens that everyone dumped that guy because they didn't need to use that anymore, because it's a built-in feature of the school that is for free. Why would you pay $50 a month to use a third party? And I did send a message to that guy. I said, I really feel for you. I'm so sorry that happened to you, right? He lost his business overnight. And exactly that's what Leon was mentioning. That's another risk, is actually the school would build a built-in feature of whatever those third parties are doing. And then all of a sudden overnight, that business is redundant and all the clients gonna come and then stop the subscription and request refund. And
yeah, I mean, guys, the way to think about Skool is just a platform. It's just how you interact with your customers and get billing and payments, and you build the community and all that kind of stuff. Like if Netflix was hosted on Skool and they delivered all their movies through Skool, if Skool said, "Hey, Netflix, I don't want to work with you anymore," Netflix would still have a business because they still have a service and a product, right? Like, don't get so tied into the fact that Skool is where you run your business. It's an amazing platform. But you have customers and you have a different product, right? So always keep that in mind. If Skool's not going to bully anybody, but if Skool's like, "Hey, I'm going to ratchet my fees 10x," everybody that's on Skool doing massive amounts of volume is going to find another platform to sell their same products and services, right? So you build the value. It's super user friendly, super easy, and it's got a very, very good amount of momentum. But don't think about Skool as your bottleneck. Think about your business more, holistically.
very good, thank you. Marcos, I'm gonna pin you. Here you go.
Yeah, this is Marcos. Thanks for all the information. It was pretty amazing. So my question is around, you said you're not scaling your business, but let's say you did, because in some ways, like I'm a high paid consultant and I've got one customer. And so my thing is, and I'm relatively new too. So
Sure.
I'm just trying to get what your input would be on that.
When you said mine, you're saying how would I scale my business?
Yes, your business.
So my business is scalable too, right? I mean, I came from a firm. We had 50 people. That was somewhat more scalable than me as a direct owner. Now the next level to that, and even that I would argue is not that scalable, because it was very much focused on, a handful of partners that were well known in the industry and they had reputations. And if they weren't there, the firm, is not really a firm, right? It's really kind of a compilation of people. But the highest level of how I would scale my business is, how do you think about Goldman Sachs? How do you think about, Bank of America? How do you think about Morgan Stanley? All of these firms have advisory arms of investment banks where they, nobody is saying, "Hey, Goldman Sachs is going to fall apart because of one individual banker," right? So the way I would have to do that is that I'd have to build a massive brand. I'd have to build a massive company and bring people on. Now, I don't necessarily want to do that because it's a very different endeavor in terms of time and the kind of effort needed. But it's a different kind of profitability for sure. But it just depends on what you really want to do. There's lots of consulting firms. You have, the Bain and the McKinseys of the world. No individual consultant is irreplaceable at Bain or McKinsey. It's a massive organization. Now, do you want to run that massive organization is a different question. I'm finding the, lifestyle relative to time value kind of differentiated. If you want more control of your time, I think the lifestyle business and kind of AI business and, the recurring revenue business is a much better vehicle for that. So it's hard to scale my business. I mean, it's not impossible. It's easy to do. I know how to do it. I just don't want to go, put the time into it, because I've already, spent the 10 years in a way where I've invested significant amount of time into it.
Oh, okay. And then how are you using AI in your business?
Yeah, I mean, there's lots of different ways. I mean, I've used Atena's platform, which is very helpful. I mean, I think being able to understand, how you create content, because there's a couple of things. There's marketing, and there's content, and there's, infrastructure and stuff like that. I haven't really used it yet for like infrastructure and billing and payments and that kind of stuff, because I haven't really explored it yet. But like in the content creation, the ideas, looking at other people's products, like synthesizing ideas. For me, it's been more of a research tool. And again, I've got a little bit of a different angle. I'm not really using AI in my services, because I don't think it will eventually be able to tell you everything I just told you. But right now, it doesn't have enough information or a basis or a data set and the experiences that I have to be able to repeat what I said. Because it hasn't seen enough information. Eventually, it will get there. So I'm not really using AI in fulfillment, but I am using it in the marketing and the content and that kind of stuff.
Oh, okay. And then how big a business? So I'm just starting, but how big a business would I have to be in order to work with you? Is it?
It just depends. It really depends on your business. I don't know if I wouldn't qualify it as like a size. I mean, if it's a brand new business, like I think I'm probably not the right place for that. But if you're generating revenue sales, like we should talk. I don't want to give a qualifier on this call. That's not really the goal. But it's any business that's kind of established and making profitability and wants to, eventually scale.
Okay.
But it's not a startup. Like if you're a startup, this is probably not the right. I mean, I'm happy to chat with you, as part of Atena's group. I would more than happy to make the time, but it's probably not the right fit just from a stage perspective.
Yeah, I understand. And then one last question too. I mean,
Sure.
So I'm more of a techie, and I notice you've got a lot of skills around sales and marketing. What's your advice for growth and mindset and all that?
I mean, I would say again, the tech, it's funny, like the tech underlies the company, and the tech could make the business valuable and it can make the product valuable, but you have to be able to sell the company and the business and pitch it to people. Like you're going to have to develop the sales, finance, the marketing, all those skills. And you can either go do it, on your own and kind of figure it out. You could borrow somebody else's knowledge and be like, hey, how do I do this? And how do I present myself and all those things? I will tell you the number of business proposals people have given me over the years, and they don't know how to pitch their idea, and it just falls flat. Somebody wants to open a sushi restaurant, somebody wants to open a bar, but they want to raise money for a real estate project, but they literally don't even know how to speak the language of the investor, and their deals just fall apart. So you've got to learn how to really think about what is the other person thinking about. It's not about, like, if your business is a tech business, the investors don't want to understand the code and the nuances of the code. It's like, what does this business do? Why is it proprietary? Why am I going to make money in this? How do I make sure nobody else copies my code, right? They don't care about the lines. Like, people get bogged in their own reality. You got to sort of transport yourself into their body and understand, how am I going to receive this message? And that was a lot of my job. That was my job. I took companies and I took them to investors, and I said, hey, how's the investor going to look at this? Not how does the company think about themselves, because the company is biased, and they're not going to get the best result. They've got their own cone of vision. So that's what I would say. Just think about how the other person's going to receive it.
All right. Thank you.
Thank you. John.
John, thanks so much for having me. I was out for a walk, and thanks for pulling me over here. I had a quick question about businesses that are being built from, let's say, white labeled CRMs, like say Go High Level, for example. There's examples like Thrive that have they're built off of white labeled solutions. So, and I'm sure a lot of companies have suppliers and things like that they rely on, but how does that look like to investors for someone who's heavily reliant on one supplier for software?
Yeah, I mean, that's a tricky piece as well, right? If you're heavily reliant on one supplier, anything that creates heavy reliance, it doesn't mean the company can't be valuable. It just means that's going to be an open question mark and sort of something you're going to have to address and, figure out how you would mitigate it if you ever had to mitigate it. So, again, it would be very dependent on the specific scenario. I will tell you, I had one scenario. I represented a company that owned there was a supplier to another company, and that company had trouble. It was a sole supplier. And so when this company ran into bankruptcy, or, almost bankruptcy, and had an issue, they had literally zero leverage because, we were the sole supplier and we had every control of that business. And we ultimately were able to, take control of that business. So I think that's a difficult position to be put in. If there are ways to mitigate it, I think that's important. I think it's also a question of how much leverage you have against Go High Level. If you're 2% of their revenue or something like that, like they obviously don't want to lose that either. Like most people in business at that level and scale are rational. You'd be surprised, like people don't, like even though their poker cards may be there and their poker face is there, like they don't want to lose the business either, because it's not easy to replace a high volume business. So I would say it kind of really depends, unless you're talking about a very specific scenario. It's the same question about the negotiating leverage around, if you had, if you're just selling to Skool, what would you do? Well, like you'd have to understand what your impact is to Skool. But I agree, if you have that kind of, if you have one customer or one supplier, that's not really a business, right? You're just sort of, you're like a contractor for, your one company, basically.
So diversify and make sure you have a good IP, basically.
I would try to diversify and make sure you have a good brand. I would say make sure you have a good brand and good IP. If you can get a good brand and good IP with your customers, ultimately you could, I mean, how hard is it to rebuild Go High Level? I don't know, but it's not $100 million hard. It's, $5 million hard, maybe at the most. All the tech is there. It's got old infrastructure in theory, right? Like, could you go rebuild it and say, hey, I'm going to go raise capital. I'm going to go rebuild this. I got all the customers. I'm going to go to get all the plugins. It's not easy, but like, that's a threat, right? It's not easy to do, but that's the way I would think about it.
Thank you.
Yep.
So much. Kishan, I have a question.
Sure.
So continuing on the John's discussion, so one thing that I had a very quick chat about you as well, about the us, right? So my plan is to make about $100 million in basically revenue with a 50% margin profit.
Right.
And the plan is to have 50% of that coming from affiliates and partnerships, and 50% come from just the direct marketing and sales that we're doing. So if we go towards that direction, number one, in terms of our business valuation, is it a good thing that 50% of the business coming from affiliate and partnership internal? Number two, what would it do? You guys want to mute yourself? Sorry, I don't know whether I'm just gonna mute this. Okay. And number two is that, what about our affiliates? Like if the people are going to invest in, let's say that become an affiliate and become really big, when the company become really huge, AIpreneurs, industry leader, $1 billion valuation or multiple $1 billion valuation, is it they're gonna be in a good position too? Because like they basically moving with the brand. If they're setting up business on something, let's say that someone build a business based on ChatGPT, and then ChatGPT, as they get bigger too. So
right.
The effect. So two questions about myself and about our affiliates. What position we're going to be looking at in the next 12 months?
Yeah, I mean, I think having like diversified revenue sources is always good, right? And especially even though you say 50% affiliates and 50% direct marketing, it's not like 50% is coming from one affiliate, right? Even in the affiliates, there's gonna be a huge diversification of the portfolio. And so if you're seeing good trends and you're saying, hey, this is recurring and people are pushing it and you're getting a lot of volume from it, I think that's a good thing, because then you've got a sort of an external sales force and team that's bringing in leads and revenue to your business. So people should look at that, kind of positively, because it's low kind of customer acquisition costs. The dynamic of, as your business gets bigger, like the affiliates aren't investors or owners of your business, right? So as your business gets bigger and the brand gets bigger and the exposure gets bigger, in theory, their economic value goes up as well. They can make more money. People know it better. People want to buy it. All those things go up. The one benefit that will happen is you will, in theory, have more leverage over your affiliates in terms of, the compensation structure and the types of things you do. You have to exercise that leverage probably judiciously, because you don't want to lose those affiliates either. But in theory, like if I was an affiliate, if Apple had an affiliate program and I had to go convince people to buy an iPhone, it'd be pretty easy, right? Like they're just so big. But then, they could say, hey, I'm going to give you 1%, and then it may not be that interesting. So it really kind of depends. But I would say as your company gets bigger, it just makes the affiliate program even better, right? Even stronger. The conversions are even better. The churn's even lower. So all those things are just kind of, it's a self-fulfilling cycle a little bit when it gets to that level. But that's the way I would think about it.
Okay. And one thing that we were suggesting to members is that they could go and try to claim the name AIpreneurs in the Skool to niche down. When it become really big, then they have the owner of, like say, Skool.com/AIpreneurs New York, US, based on the geography or based on a particular like a woman founders or something like that. In that way, they become the industry leader on the niche. So AIpreneurs is a mother company, and they have all of those little company that, you know, form underneath that they're all niching down based on a particular geography or demographic. And that's one thing that I suggested. So when the company become very big, then they become the industry leader on that. And then another potential that we were looking at is that potentially when our affiliates, some of them can become really big, we buy them out and we kind
Right.
of on.
Yeah, I mean the other business model, which I just thought about it now that you mentioned that, that's actually probably really relevant for you, is the multi-level marketing, right? The agency model, because then you're no longer a tech company, you're an accelerator, you're a product pipeline for people that want to, you know, build chapters and you know, build their own programs. That's a very actually differentiated way, as opposed to looking at it directly as, you know, selling a product and a service. It's like, how are you selling, you know, services to build your own businesses? I mean, that like MLO businesses are very big. Those have had big buyouts. It's actually a really interesting way to think about it too.
It's good. We probably need to have another chat to go a bit more deep dive into that.
Yeah, exactly.
Fantastic. All right. Any last question, guys? Because we're gonna have the AIpreneurs closing ceremony in 3 minutes. If there's no other question, we're gonna wrap up here. And then thank you so much again, Kishan, for your time. Really very, very valuable information. We learned a lot. And I hope that everyone made a lot of notes. Make sure that you connect with the Kishan. I'll put his Instagram link in the chat as well. Everyone in this group, please connect with Kishan. He give a lot of value in his social media. Connect with him, invite him to your podcast, and try to take advantage of, you know, this amazing presentation. And a lot of things to think about after today, right? Some things that you guys never thought about, like maybe building a business for a high valuation. Never thought of that before. Now you know the tricks, how you need to build your business, what you need to look at. Very, very valuable. Thank you so much, Kishan. I really appreciate it.
Thank you. Have a good day,
Thank you so
guys.
much. Thank you,
Bye-bye.
Kishan.